Welcome to Talk Tickers. Today, we're ripping the cover off the numbers for Sunoco LP's Q3 2025 earnings call. And this quarter, it really presents a fundamental paradox.
It really does. You've got management engineering, well, probably the most ambitious transformation in the partnership's history. Huge deal closing.
Right, massive. But then the headline financial print, it was messy enough to make any investor, hit the pause button.
Exactly. So we aren't just summarizing an earnings report here. We're trying to assess whether that immediate market volatility was warranted.
Or if the long-term structural story they're selling, based on this massive new scale and the promise of synergies, is robust enough to sort of ignore that short-term noise.
That's the mission. Can management's incredibly bullish outlook actually be supported by the strategic chess pieces they've just put in play? Let's find out.
Okay, let's jump right into that financial noise then. Because honestly, if you only saw the GAAP EPS figure, you'd probably assume this was a disaster.
Yeah, it wasn't pretty on the surface.
The GAAP earnings per unit came in at $0.64. That is, a substantial miss compared to the Zacks consensus estimate of $1.54. You just can't ignore a headline like that.
You can ignore it, no, but you absolutely have to contextualize it. That GAAP miss was heavily polluted by one-time costs, all related to closing that monumental acquisition.
The Parkland deal costs.
Precisely. Transaction fees, restructuring costs. You strip those out, and actually several research firms are characterizing the adjusted EPS as a comfortable beat. Closer to $1.92.
Okay, so a tale of two EPS numbers, really. Depends how you adjust.
It really underscores the difficulty in, of accurately modeling a quarter that's defined by such a huge transformation.
But the top line, the revenue, that was clearly healthy, which often feels like a better sign of operational momentum than, say, adjusted earnings anyway.
Agreed. Revenue was a strong beat at $6.03 billion. Comfortably exceeded the $5.66 billion consensus. That represents respectable 4.9% growth year over year.
And operationally, underneath all that noise.
The engine is humming. They delivered record-adjusted EBITDA, $496 million, if you exclude those one-time transactional costs.
And how does that compare?
Compares very favorably to $470 million in the prior year. Net income also improved dramatically, soaring to $137 million, up from just $2 million in Q3 2024.
Wow. Okay, so that growth, it points directly to strong underlying performance before you even factor in the integration drama.
Exactly.
Now, here's where the numbers get a little more complex, I think. Despite that record EBITDA, distributable cash flow, DCF, the money they actually used to pay distributions, came in slightly lower, $326 million versus $349 million a year ago.
Yeah, and that dip is basically the cost of transformation. It reflects two main things. First, higher capital expenditures being deployed into new growth projects.
Makes sense.
And second, significantly increased interest expenses they're now paying to finance the debt they took on for the acquisition.
So it's a deliberate trade-off then. They're prioritizing long-term scale and earnings power over maybe maximizing short-term DCF growth.
That seems to be the strategy, yes.
And the market's response to this whole mixed bag of results, it was pretty interesting to watch.
It was. Initial price action was choppy, definitely.
Yeah.
Dipped maybe 2% or 3% when the report hit pre-market.
But
then the units quickly stabilized once the management call actually started, ended up closing nearly flat for the day, up just 0.3%.
So that tells us investors pretty quickly discounted the noise and shifted their focus entirely to the strategic roadmap, right?
Seems like it.
Yeah.
And that strategic roadmap is really where we need to spend most of our time because management is fundamentally restructuring the entire platform here.
Okay, let's talk strategy. The centerpiece was obviously closing that Parkland deal, roughly $9 billion.
Approximately, yes. The successful closure of that deal was the absolute focus of the discussion. And it's huge.
How huge? What does it actually do?
Well, it immediately establishes the combined entity as the largest independent fuel distributor in the entire Americas. We're talking 26 countries.
26. And I think the really important tactical element, for us anyway, is the asset base it adds, particularly that refinery in Burnaby, British Columbia.
That's right. And what's fascinating here is that this acquisition isn't just about adding volume. It's about moving them up the value chain.
Oh, so?
That Burnaby refinery provides a new level of vertical integration. It allows them to capture refining margin, not just distribution margin, in a really key geographic area.
So more control, potentially more profit per gallon in that region.
Potentially, yes. Management really emphasized the sheer scale they command now. Over $3 billion in pro forma adjusted EBITDA generated by the combined companies over the last 12 months,
And the volume.
supported by over 7 billion gallons of contracted fuel demand, primarily across the Atlantic Basin. It's a massive footprint.
And they didn't stop there, did they? They also mentioned another deal pending.
Correct. They kept moving, highlighted the pending agreement to acquire Tankwid that adds 16 key fuel terminals in Germany and Poland.
So extending their European terminal footprint. When does that close?
Expected in Q4 2025. This really underscores their commitment to building out these diversified, fixed-fee midstream and storage assets, but now on a global scale.
Okay, so you do these massive deals, you take on debt. The next logical step is you have to promise synergies, right? Big ones.
Monumental promise, really. They reiterated the target, achieve at least $250 million in run rate synergies by year 3 after closing Parkland.
$250 million. That's not a small number. It's designed to drive, what, over 10% accretion to DCF per unit?
That's the goal. Greater than 10% accretion. It's crucial for making the math work on these deals.
But where does that $250 million actually come from? Is that just, slashing jobs, or is there something more sustainable baked in?
Management was pretty specific, actually. Said it's a
Yeah.
balanced approach. Roughly half comes from operational expense discipline, rationalizing overlapping back office functions, reducing headcount redundancy, that sort of thing.
Okay, the usual cost cutting.
Right. But the other half, and this is the key component they stressed, comes from commercial optimization,
Wait.
supply-side gains, using their drastically increased scale to negotiating better fuel purchase prices, optimizing inventory movements across the whole combined infrastructure network. That commercial aspect is potentially far more sustainable long-term than just cutting costs.
Got it. Now let's shift gears slightly. Scale and synergy are only part of the story. How do they actually plan to attract the massive pools of institutional capital needed to justify this new global platform?
That's a really important question, and it addresses some of the, let's say, legacy issues of the MLP structure.
The K1s.
Exactly.
Yeah.
So they referenced the launch of SunocoCorp, which will trade under the ticker SUNC. This is a new C-corp tracker expected to trade on the NYSE, and it holds a 27% LP interest in the underlying SEN partnership.
Okay, break that down. Why should you, the investor listening, care about the difference between a C-corp tracker and the traditional MLP structure?
Well-
It boils down to taxes, right?
Precisely. The core issue historically with traditional MLPs is that K1 tax form. It complicates filing for investors, sometimes requiring them to file returns in dozens of states where the partnership operates. It's a headache.
And that complex reporting structure, it basically locks out huge pools of capital.
Absolutely. Foreign investors often avoid them. Domestic institutional investors managing vast numbers of accounts find it cumbersome. And, maybe most importantly, tax-sensitive retirement accounts like IRAs generally steer clear.
So if K1s mean complex reporting that locks out capital, the new C-corp, SUNC, it provides 1099 reporting instead.
That's the key unlock. The 1099 is the standard tax form you get from owning regular stock. Much simpler. By offering the 1099 structure through SUNC, they hope to attract that previously restricted institutional and retirement capital.
And they mentioned something about taxes at the corporate level, too.
Yeah, they projected they'll pay minimal corporate income taxes for at least 5 years. So trying to maintain that tax efficiency while delivering the reporting simplicity the big money demands, it's a clever structure, potentially.
Okay, interesting structural innovation. But before we get fully lost in strategy, let's quickly look under the hood at the operational engine again, because you mentioned there were some real pressure points in Q3.
Absolutely. We saw a pretty stark contrast between their two core business segments. The traditional fuel distribution segment, well, it showed some weakness. Adjusted EBITDA declined to $232 million, down from $253 million year over year.
And the driver there was margin compression?
Mostly, yeah. That margin compression is a key insight. While volumes were actually strong, about 2.3 billion gallons sold, outpacing overall U.S. demand growth, the profit per gallon margin fell significantly, down to 10.7 cents compared to 12.8 cents a year ago.
Why the drop?
Management attributed to a couple of things. Tempered market volatility, which means fewer chances to make those outsized merchant fuel profits from price swings, and also higher operating and break-even costs across the industry. Just shows the inherent volatility of that part of the business.
Okay, but that volatility was balanced out, hopefully. The stability theme they've been pushing, diversifying into fixed fee assets, was that validated by the midstream segment?
It was, exactly as management hopes. The midstream assets are essentially acting like a toll road. They collect predictable fees, largely regardless of the price of fuel moving through them.
So how did midstream perform?
Very well. Pipeline Systems adjusted EBITDA rose substantially to $182 million. That's up from $136 million, mostly on higher throughput. Terminals adjusted EBITDA also grew, coming in at $75 million, up from $67 million.
So that provides the crucial foundation, that sort of financial stability, to offset the merchant risk on the fuel distribution side.
That's the idea. That's the diversification benefit they're aiming for.
Okay, turning to capital allocation then. Q3 capital expenditures were $157 million. Growth CapEx was about $115 million of that.
That's right. Reflects their focus on funding growth projects across the newly expanded portfolio. They talked about a best project wins mentality across all segments.
And a top priority you mentioned is the balance sheet, especially after taking on all that debt for Parkland.
Definitely a top priority. Net leverage stood at 3.9 times at the end of Q3. Now, management is confident, actually, more confident than before, that they will return leverage to their long-term target of 4.0 times within 12 months of the Parkland closing.
Within 12 months. That sounds pretty bullish. Is that target credible, considering the amount of debt they just took on? Hitting 4.0x within a year feels like an aggressive acceleration of the timeline they previously communicated.
It is aggressive, no doubt. What makes management confident, they say, stems from their belief that they can realize those large, immediate operational synergies, particularly the commercial optimization stuff we talked about, faster than they initially anticipated.
And hitting that 4.0x leverage target, why is that specific number so important?
It's important because it's generally seen as the threshold where credit rating agencies feel comfortable. It allows them to maintain efficient access to capital markets, which is obviously crucial for funding ongoing growth and refinancing debt down the line.
And they're backing up this growth story with returns to the investor too, right? The distribution?
Yes, the quarterly distribution was raised again by 1.25% to just over 92 cents per unit. That marks the fourth consecutive quarterly increase.
And that's consistent with their commitment to deliver, what was it, at least 5% annual distribution growth for 2025.
Exactly. At least 5% annual growth for 2025, and coverage remains robust, around 1.8 times in the quarter.
Looking ahead then, the scale they've achieved, it's projected to generate some serious cash flow.
That's the projection. They believe the combined entity will generate over $1 billion of annual free cash flow in the, quote, near future. That represents a huge, like a 50% plus increase over the standalone Sunoco case.
Okay, big numbers. However, formal 2026 guidance for the whole combined company was pushed back, now expected early next year, instead of the usual December timing. Doesn't pushing back guidance maybe signal some integration complexity, even if management says they feel even better about the acquisition?
That's a fair point, and honestly, it's probably the primary source of any remaining market skepticism. Management pushed back on that interpretation, though.
What did they say?
They stated the delay is less about integration difficulty and more about just needing time to finalize the pro forma numbers for the massive Parkland close, plus factoring in the ongoing acquisition of Tankwood. They actually stated on the call multiple times that they feel even better about the Parkland deal now than they did back when it was announced in May.
Suggesting the underlying economics are solid despite the, let's face it, structural complexity of putting it all together.
That's the message they're sending.
Okay. Briefly, on the macro side, did they address geographic opportunities or risks?
They did. Discussed how ongoing refinery closures down in California might actually shift the U.S. West Coast into being a net import market for fuel.
And how does that benefit Sunoco?
Well, they believe their new Burnaby refinery up in B.C., combined with their existing West Coast terminals, will allow them to use their new scale to capture supply advantages in what could become a tightening market out there.
Interesting potential upside. And any external risks mentioned, like weather.
Yeah, they quickly addressed Hurricane Melissa, noted the impact was largely limited to their business in Jamaica, which is now just a small part of their big 26th century footprint. They don't anticipate any material impact on Q4 or 2026 results from that storm.
Okay, good context. So we've covered the complexity, strong revenue, huge strategic wins, but against that messy, short-term gap miss, and with this massive synergy target looming, it's time for our high conviction segment.
All right. This is not financial advice.
Okay. Given the dramatic structural change, especially the creation of the C-corp SUNC, what's the high conviction, high upside, maybe high risk idea to capture this transformation, kind of bypassing the old MLP baggage?
Okay, the trade idea here is really focused on capturing that structural unlock.
Yep.
Long SunocoCorp, ticker SUNC, and short the Alerian MLP ETF, ticker AMLP.
Right. So you're suggesting buying the new, arguably more complex C-corp structure while simultaneously betting against the entire MLP sector benchmark. Walk us through the rationale for pairing those two specifically. Why short AMLP?
Okay, the thinking is this. The market is currently valuing the combined Sunoco entity based partly on integration risk, yes, but also partly on the tax baggage of that legacy MLP structure, K1 complexity.
Which SUNC solves with the 1099?
Exactly. The launch of SUNC provides this clean 1099-based avenue to unlock all that non-tax sensitive institutional and retirement capital that generally avoids MLPs. That potential capital inflow is a structural tailwind that the entire MLP sector, represented broadly by AMLP, simply doesn't possess.
But the high risk here is clearly execution, isn't it? I mean, if the synergy goals are missed or if that leverage target slips past the 12-month window, SUNC is going to get hammered regardless of its tax structure. Why assume management executes flawlessly on such complex integration?
That's absolutely the risk. We're not assuming flawless execution, but we're betting on the appeal of simplified taxes combined with the mandated growth trajectory. The trade hypothesis is that the combination of factors that guaranteed 5% distribution growth floor, the minimum $250 million synergy target, and the simplified C-corp tax structure will eventually drive a significant valuation premium and sustained outperformance for SUNC relative to the lagging total returns of the broader K1 burdened MLP sector.
So you leverage the structural advantage of SUNC to capture the potential operational upside while hedging against general MLP sector malaise with the AMLP short.
That's the concept. You isolate the Sunoco-specific transformation story.
A compelling, definitely high-risk pitch. Let's try and conclude this deep dive. What's the main takeaway?
I think the key takeaway is that management is explicitly, clearly asking you to look past Q3's noisy GAAP EPS print. Forget the short-term static. The entire focus now is on the execution of this sweeping Parkland and Tanquid scale strategy.
Right. Record-adjusted EBITDA and that really aggressive $250 million synergy target, those are underpinning the forecast for generating over $1 billion in annual free cash flow. The whole story now really hinges on management's ability to hit that accelerated 4.0x leverage target within 12 months and, crucially, deliver those synergy milestones on schedule.
And maybe a powerful thought to leave you with. SEO units themselves, the underlying partnership, they've delivered roughly flat price performance over the last year. Pretty boring. But their total return is meaningfully higher thanks to that attractive yield, currently around 7%.
So the yield has been the story.
Pretty much. So the big question is, if the synergy goals are met, and if that accelerated leverage target is successfully defended, does the market finally reward this new, scaled, diversified platform with a fundamental multiple expansion, something beyond just paying investors for the yield?
That really is the question for 2026, isn't it? Fascinating stuff. Thanks for joining us for this in-depth look at Sunoco's truly transformational quarter.